我们今天特别邀请到施罗德投资亚洲多元资产投资主管 Keiko Kondo 为我们来揭示2026十大关键预测。So, ladies and gentlemen, please help me in welcoming Head of Multi-Asset Investment Shoulders Asia, Ms. Keiko Kondo. 掌声欢迎。
Good afternoon, everyone, and it's lovely to see you all gathering here today. It's been a year since I was standing right on this spot a year ago, looking on my phone right there, thinking of who was going to be the US president. That was the day of the US election. I was here last time, and of course, as we saw the result coming through at the time, saying, oh, Trump's winning, oh, this is going to be an interesting, unpredictable year. I remember thinking that as I was speaking a year ago. And certainly, it has been a very interesting and I guess that year with a lot of disruption so far. So I would say when we look back, 2025, certainly what we do see here, as I try to point out, sorry, let me walk to this side because I can see my slides this way better in English. You see in Chinese here. Sorry. So certainly when we look at the Trump 2.0, we knew a lot of the policy changes were going to come through the moment he was elected. Certainly, he did not disappoint us. In fact, he did more than a lot of us had thought. So it's been a lot of disruption, including tariff debates and so forth, which still comes and goes, but something that we are likely to still continue to see into next year. Probably more policies to come. But I guess outside of sort of the policies and concerns we did have, and certainly the disruption, there are a few things I will make remarkably different this year. We saw Asia market came back very, very strongly this year, which is something that I certainly appreciate, managing the portfolio based in Asia for clients in Asia. I'm sure everyone's happier to see the performance of the Asian markets done much, much better this year, even compared to the US market, which has been doing very well over the recent years, but Asia did better this year. So in some ways, that is a nice change, a welcome change we certainly had. Behind the scene, still, we do see that AI, and I know Brian already talked about the different themes that we covered in this conference. Certainly, the world of, obviously, the excitement going around, the AI enthusiasm, driving themes through the market, something we did see this year, and we think we are still in the early stage. So there are a lot of implications we will see, but the theme that we see today, we believe that's still more to go, which is probably also a very good thing for Asian economies, considering Asia as a region play a very vital role in that space. So I think when we look back, this year in the end was a very good year for markets generally. And a year ago when I stood here, these are the top 10 predictions I presented a year ago for this year. I would generally describe these 10 ideas that I presented last year as, let's take risk, let's try to generate the returns, be rewarded. Don't be afraid, I think the environment is good, was really the message that we did present last year. So amongst 10, let's see how we did. 9 out of 10. Thank you very much. I remember last year was 8. And I remember saying, oh, 8 is a very good number. It's very, very hard to beat. And I am very pleased to see that I have managed to get one more even right this year. But at the same time, this also illustrates how good the market has been consecutively for 2 years. That does, in fact, raise a lot of concerns or uncertainties. People increasingly ask me, what about next year? Are things getting a little bit too expensive, or are we still okay? A lot of the questions we're receiving. So this is something that we think deeply, and certainly, as Brian said, we are active managers. We live on these and trust our active management, please. But I think this is definitely the environment that we do find that is actually something that potentially changing in a landscape that we could see, and we need to navigate through thinking what that means at any point in time. So I guess looking ahead to 2026, before I go through my upcoming top 10 predictions, I'd like to sort of go through some of the thinking that we have around the environment we are in today and potentially how that may change in the coming months moving into 26. Obviously, I always talk about how important the US economy is because the US does have a large consumer segment which really drives it has an implication to the global economy. So let's look at how the US economy is. So the left-hand side chart here is showing that Q3, so the very recent quarter, how the US economic growth delivered. So what we did see, the expectations started actually quite healthy at the start of the quarters. Things actually, expectation went a little bit lower. And then as we went through the quarter, things came in strongly. And then we ended up the quarter quite well. So the growth did continue to deliver, even though a lot of people started to get concerned. And I'm sure a lot of you remember we started to see some soft labor market data and so forth. But when we actually look at the GDP growth for Q3, it's actually quite robust and resilient. And on the back of that, US economy, when we look at upward gap, continues to operate at the full capacity. So even though everyone's worried about, what's next, actually the growth in the US is quite resilient. And I think the key here is that then what's going to happen to consumption and retail in US in going forward, because that is a large part of the US economy. And for us, the key in understanding what's going to happen to the US economy is what's going to happen to consumption, and in order to support the consumption, consumers need to be able to consume, and that means that real wages, I know it's a little bit boring chart on the left-hand side because the line's sort of stable or flat, but that's exactly what we need. We need a stable real wage growth in a positive territory, which we are. Is that something that is driving the consumption engine going? And we don't see the sign of deteriorating at all, despite some of the soft labor market data that we've seen in the past few months. And on the flip side of that, supported by this healthy real wage growth, right-hand side, you will see that the US retail sales, which was a little bit softer around the springtime, people got very nervous with the news of tariffs, and we saw some crazy numbers at the start when the picture I showed you at the start, when Trump held the board showing all the tariff rate, everyone got nervous or what's going to happen. So there was a bit of a disruption to consumption behavior. But quickly, things started sort of moved on. Nothing really got broken. Retail came back. So the retail consumption in the US is still very healthy, which is very important for the US economy. And the question is, can we keep this up? I guess the soft job market is something that I already started to mention, and a lot of the attention to that and the market reacting to this, some Federal Reserve comments also on the job market. But what we do show here on the left-hand side is the new job creation, which is actually soft. This is where we are worried about. Payrolls not growing as fast. I don't have a chart here, however, when we look at the US unemployment rate, which is only 4.2-ish, which is actually compared to history, it's still very low. So the labor market is tight. It's not because there aren't enough jobs. Simply the US job creation is slower because of uncertainties. Companies are a little bit reluctant to hire new people, but also the labor market is tight, so keeping the existing people. So the turnover of the jobs are actually not very high, doesn't mean that the labor market is poor. So it is something that we do find interesting, because typically if we just look at the slow job creation, we will suddenly be very nervous. But if this continues and unemployment rate rise, we should also expect the real wage growth to come down. But what we don't have today is that the tight labor market, potentially to somewhat to do with maybe the demographics as well. There may be a little less participation, but the market is tight. So we find that still the labor market is healthy, and if the wage growth are to be continued at the stable pace we saw in the very boring chart, as long as the chart remains boring, we think we are in a good environment. So that's something, one of the signposts for next 12 months. Please do remember, when you hear the news saying real wage growth in the US starting to come down. That's a warning sign. But as long as you don't hear that, and usually when it's boring line, you don't hear about it at all. When you don't hear that, I think the environment is the likelihood that the growth is okay. Then coming back to the home region, what about Asia, which we have done, as I mentioned, very well this year? What's driving the Asian economies? Of course, we had a bit of the disruptions in April around the tariff policies. But what's interesting is that on the left-hand side, I'm showing that the export growth for Taiwan, Vietnam, and China. China line really down because we know what happened with the trade policy. But when we look at healthy export growth from Taiwan, but also a country like Vietnam, China is not the first time dealing with the tariff policies and sort of the Trump trying to really play some difficult policies against them. So rerouting is not something that is new to them. So in fact, when we see the weakness in export numbers out of China alone doesn't really concern us because China companies don't necessarily operate everything in China. There are some offshore activities as well. So what's more important then for the market and the economic sentiment? What about the broader Chinese economy? This is where it has been a bit softer in the recent years compared to other parts of the world. But when we look at activities in China, it is not very strong, but it's not falling like it used to. It is stabilizing. And I think that's good in the sense that if at least stabilizing, and when we look at some of the recent policy directions that are being announced by Chinese government, there's definitely going to be more focus on really trying to stimulate consumption and support the consumers, which could be extra bonus. But the fact that it's stabilizing, and when we look at the market, we do find still the Asia market, China market, trading at much more reasonable valuation compared to some of the developed markets, such as US. So they are still definitely something we should be excited about in terms of the Asian economies and Asian markets. So I think those are, the sort of the place we do see. So the US economy resilient, probably a bit slowing, which is actually healthy. But at the same time, if things go a bit more difficult than that, Fed will step in and cut rates more aggressively. Because right now the interest rate's much higher than obviously used to be a few years ago. Monetary policy is there to support. So we do also have sort of the cushion that was offered by the Federal Reserve Bank in terms of monetary policy. So we find that still our basic view that we do have today is that we still do see very little probability of US economy hitting recession anytime soon. I remember saying this last year too, but we still see very low probability of US economy hitting recession. And maybe only moderating growth, inflation in control, which does paint sort of the nice environment that we have seen. Of course, market always gets a little bit excited too fast and too quickly. Sometimes will be volatility, but if you look through the noise, we believe that still the environment is generally still positive to generate some returns and seek opportunities. So now, I'm sure this is the more interesting part. Everyone's sort of excited to hear, and this is the biggest challenge for me. After 8 and 9, as a multi-asset investors, I always tell my team, we need to get 6 or 7 right. We don't necessarily need to get 10 right. And the fact that I've gotten 8 or 9, and if I'm trying to average 6 or 7, I'm almost feeling like I might get 5 eventually soon. And I worried about that ticking time bomb, but let's see how it goes. Let me try to start sharing the top 10 prediction for 2026. So the first one is, this is the same one actually, by the way, as the one I had presented last year. I still like US equities. However, I like to be broad-based. And the way I say broad-based is potentially because obviously I'm sure many of you probably held S&P ETF, NASDAQ ETF that made a very good return, and everyone probably happy from that. But what we consider as a potential risk down the road, they might do well, but they might do with a very high volatility. We saw Liberation Day market falls very sharply. Those mega cap stocks are now extensive, a bit rich in terms of valuation. It's easy for investors to quickly panic and take off the risk. So as a result, what we call index problem is the market cap concentration. So we like you to recommend you to be more broad-based. If you want to sleep better, not worry about as much about the volatility. Going more broad-based, something like S&P equal-weighted, or leave it to active managers like us to manage more stock selection for you is probably a bit more the safer way to make you sleep better at night while still being invested. So we find that US equity is interesting and still meaningfully attractive. Left-hand side shows that profit expectation for equities around the world is actually being upgraded by analysts, US leading the league. So US expectation is still strong, but we also will point out that increasing number of stocks, for example, in NASDAQ, there are cases of companies that are having no revenue or negative profit. Those companies are starting to count as more. Not so much in the market cap sense, but we are beginning to see more cases. This is a little bit, by the way, a bit unfair chart, because when my colleague created this chart, the first question I asked is, can you show me .com? How bad was it? And they couldn't go back and extend the chart for me, because I know when I look at the price earnings multiple from 2000, it looked actually even richer than today. So there are some elements of this, but certainly the fact that the number of companies that are not making profit is increasing as a part of the index is a bit of a concern. So that's a bit of the warning sign, and in order to navigate us through, take your risk wisely. But still, there are opportunities there. So that's the US, and certainly we know that the US market is a very growth-oriented market. But speaking of the growth-oriented market, there's a better value in Asia. I did show you earlier that the China equity valuation is cheaper than global equities. We can say the same thing about Asia technology stocks versus US technology stocks. So on the right-hand side, the green line is the US technology sector price to earnings multiple. Dark blue line is the Asia technology sector price to earnings multiple. Two things to note. Absolute level of the valuation gap, still quite wide. US valuation, not exactly the peak, but approaching sort of where it was high. This doesn't mean that the market will fall. If the profit grows, you can still have a bit upside. That's why we still like the market. But if you look at the Asia market versus the historical sort of the recent peaks, we are noticeably below. So not only cheaper than the US, but also versus own history, it's cheaper. It does give you a bit more the safety and potentially more of the catch-up that the Asia technology stocks can do. And I think that's, from the price viewpoint, already attractive. But then I think another thing, I'm sure me standing here, you're from Taiwan, I'm sure you feel even closer. Technology, semiconductor demand, which is a vital part of the technology sector for Taiwan economy. When we look at the industry experts forecasting the global semiconductor demand for upcoming years, we are still seeing that the forecast is a very high single digit, almost like 8-9% annual growth every year. That's a very good environment. And because Asia plays, I know one point everyone was all about NVIDIA, but technology is not just NVIDIA. It is a broader base. And in order to have any technology these days, it requires chip. And Asia economy is so embedded in that process. So we find that the Asia technology sector with more reasonable valuation is something that we do find as opportunity to have. So US, Asia, both are growth. Where else? Where should we diversify? Because technology also, I'm sure everyone will say, it's a bit rich in valuation. Isn't there something else? Let's turn to Europe. Europe, we find value is the key. If you're going to buy tech, buy US and Asia. But if you're going to buy more diversifying different kind of equities in Europe, please look for value sectors. We find that the banks and industrials could be an interesting way to really gain exposures for European stocks. Keep in mind that the European banks, which struggle structurally, is now beginning, or in the past, is beginning to see the profit growing. So you see that the line, the blue line is showing the profit trend for European banks coming up, and the market is lagging. So the market is, if we are to follow the path of the earnings, has a bit of the room to catch up. And of course, separately, we know that the European government, in order to basically support their own defense sectors and so forth, reduce reliance on the US, there's going to be a lot of defense spending. That also goes to industrial sector. So I guess the news headline talks about Germany boosting up the defense spending and so forth. But generally speaking, industrial sector, European defense spending will go, basically will be where we find the growth potential. Market did get excited and a bit of the steam being off now. It's potentially a good theme to revisit on a multiple year basis. So we find growth for US and Asia, but for value, Europe. Let's try to be a bit more balanced on the style. And number 4, because the market has come a long way, we think that buying something like convertible bonds is something interesting. Convertible bonds is a unique asset. If I were managing an institutional portfolio, I would be buying call option to participate or buying a protection through put. By convertible bonds on its own basically gives you the characteristics. So it gives you the 80% sort of participation on the equity upside, but only 60% participation on downside. So your payoff is non-linear. It's an automatic pilot for you. And because we find that we should still be looking to harvest the opportunities, but not just blindly, with some protections down the road, because we've come a long way, this is a way for me to increase my chance of not going down to 4 or 5, but potentially somewhere more like 6 or 7 for next year. This is basically take risk, but with some protection. And number 5, this is an idea I did present, not last year, I believe 2 years ago. I'm sure investors in this room, a lot of you love income. I also manage income portfolio. I know how Asian investors, everyone loves income. And taking some credit positions certainly has been very rewarding. But where we are today, after the very strong rally in credit, is that right-hand side shows the high yield market, US high yield spread, which is approaching the historical low. This still gives you better than cash or government bond. So it's a nice way of harvesting income on its own. However, with such a tight spread, if economy is too slow, you're very exposed. So in some ways, that because also the spread is tight, upside that you can generate beyond carry from high yield has become smaller and smaller and smaller. So your upside participation's not so much. You get a bit of a carry, but significantly exposed to downside. Then, why don't we actually find the opportunity to be a bit more selective if we think that if we want to grab the return, we should potentially shift some away from high yield and then buy a bit more the small cap stocks, which gives you more upside participation. And this is a very different risk level asset, so we would say try to balance it out. But what's interesting is that on the left-hand side, the chart on the left shows that small cap stocks in a rate cutting cycle without recession has a very strong return because the interest rate coming down, environment becoming easy, no recession. It's a wonderful environment for small cap stocks. So small caps perform very strong. Rate cutting cycle with recession, it doesn't matter the rates going down, but the recession hurts the company. So small cap performs pretty badly. Because we believe there will be no recession anytime soon, small cap could be in a sweet spot to generate the returns that the high yield no longer generate. So we are pairing that to say high yield, probably maybe start taking some profit down, and then maybe have a bit more of the small cap stocks to give you more upside participation. Number 6, short US dollar. I don't know if you noticed because I went through quickly on my top 10 prediction from last year, one I got wrong was long dollar. I am flipping the side this year. I am moving short US dollar. Dollar has been definitely the safest and the best hedge in town for many, many years. US equities perform well, US credit perform well, other than 22, after the 22, even US Treasuries gave you pretty good return. Dollar has been a very, very good asset. However, this year, dollar started to change the tone, partially because of the policies. I would say also because the US rate is starting to come down. So the interest rate differential started to work now on the right-hand side. The dollar interest rate versus other currencies like the euro and any major currencies, you can name it, the gap is narrowing, which does augur for softer dollar. More importantly, I would say probably since the Trump 2.0, a bit unpredictable nature of the US policy makes everyone be a bit more nervous, especially after the dollar decline we've seen this year, thinking, maybe twice, 3 times about maybe I should diversify, move a little bit outside of the US dollar assets. So those de-dollarization is a theme that, or the trend that we believe has already started and potentially could take longer time to learn because to play through because it come a very long way, just like other financial assets. So we find that the de-dollarization as a trend is likely to continue unless US economy falls recession. Recession, suddenly the dollar probably will become the safety asset again because everyone would dash into US Treasury market to buy. But if the economy is sort of slowing but only moderating growth rather than falling into recession, we think that the investors will gradually take opportunity to diversify away from dollar. So we believe that we are sort of in that period where we think that dollar is either stable with a bit negative bias, either stable at best or a bit more negative bias in moving forward. So we are turning short dollar. Hopefully I'll get right this time. And speaking of short dollar, then where should we go? We find, this is one idea we did already present last year, we continue to like, EM local currency debt. EM countries, in fact, compared to some of the developed economies, have less of the fiscal burden. When we look at the debt to GDP ratio, I know it's a bit busy chart, you see the developed countries have a very high debt to GDP ratio, even compared to some of the emerging markets. Because the emerging market, to control the currency fluctuation, they cannot just load up on debt. So the fiscal sort of discipline is stronger in the emerging countries, and they also have a higher interest rate. So the EM local currency bond, which offers you better carry and potentially ability to move away from dollar, is something that we do find is being quite attractive and something we continue to like. So one of the choice moving away from dollar asset is the EM local currency. The other one is gold. Gold is also something that we did have already last year. It went through way much faster and stronger than we had anticipated. And I sort of then take a step back and say, oh, should we be actually taking profit? I believe the market movement recently is a bit of that. Everyone got a bit nervous how fast it went. But when we look at the gold, we find that there's a special force or the trend that is pushing the gold market. So on the left-hand side, we're showing here the line that shows how gold is playing a much bigger part of the central bank's reserve. Of course, many years ago, when the gold standard was in place, gold was naturally the part of the reserve. Gold came down significantly. Now, increasingly, especially in developing economies, we are finding that the central banks are using gold as a part of the reserve. And their purchase have not stopped, despite how far gold price has moved up. We were actually a bit cautious in the middle of the year when the gold came up first and a bit slowed down the momentum. And we thought, this might be now a little bit expensive for central banks to continue buying. But we actually checked the data. We still see that the continuation of the buying interest. And beyond wearing as jewelries, we are also seeing that the retail investors are also being excited. So on the right-hand side, the retail flows into gold instruments also starting to pick up. And in fact, as the market corrected, gold price quickly went from 4,600 down to 4,000. Everyone was thinking about buying. So we see the additional purchase come in, stabilizing even faster than equities. So we find that the gold is unique. And in fact, when I talk to Asian institutional investors, I see more the comments about when you move away from dollar, where should they go? European investors will naturally go to euro or sterling. Asian investors, different countries, you can come back to your home currencies, but the home currency market is smaller. Where else can we go? We find that a lot of the Asian institutional investors talk to us, what about gold? We see increasing number of clients historically didn't want to have gold in their portfolio as a standard, sort of what we call SAA, strategic allocation. We now see more institutions wanting to have some gold allocation as a part of the portfolio, as a more stable portion. It's not a huge rate, but since it's been basically more opportunistic in the past, becoming more stable part of the portfolio, there's a demand for gold. So we find the gold is an interesting one. And number 9, alternative energy. We talked about AI. AI is a very, very power-hungry segment. I'm sure all of us, before going to bed, plug in the phone, plug in iPad, plug in everything. You have so many things. And one thing I do find as I travel every time nowadays, when I check into the hotel, first thing is how many power plugs do I have? Where can I plug things in? Everything eats power. I even have an AI pet, which also requires power as a food. So when you think about the demand for power, we also need to have the power to keep this going. But also looking ahead, given the different weather issues and so forth, we need clean energy, alternative source of energy. So we find that this is a running theme. If you believe in AI, you need to believe in alternative energy. So we brought this theme back also because the sector was actually going through some of the sustainability that went a little bit too fast. There was a bit of a correction. Now we begin to see a bit more of the comeback. It's a bit more genuine demand that is actually supporting. So we do find that is a running theme that could be there. And then as a final point, number 10, because all the public markets, whether equity or bonds, it's been very, very profitable, nice environment, everyone should be happy, but also means that a lot of things are correlated. So if we start to think things start going wrong, where can we get asset that behaves differently? Gold was one of the examples within the liquid space. But you need to sort of think about what would not necessarily have that as high correlation, especially in a down market. Private asset which doesn't trade on the exchange, doesn't trade necessarily on the sentiment, and increasingly becoming available not only for the large institutions, but also for retail investors. There are different ways to access this segment. This is the asset class we believe is uncorrelated, especially in a down market. So if we are to think that you made a good return, where should I diversify? Private assets, whether equity, credit, or infrastructure, so forth, which has a very real asset backing behind, are something that we will recommend having some exposures in the portfolio. So summing up, 10 predictions, I would say compared to last year, which was actually still, there are returns to be harvested. I would say there are still some returns to be harvested, but diversify and take risk wisely is probably what I would say from the top 10 themes into next year, 2026. So thank you, and I believe I will open up for questions.
Thank you, Keiko, for these valuable insights. Can we give Keiko a big round of applause? But Keiko, please remain on stage for a while. As we can see, there are lots of questions for our distinguished guests coming up. And allow me to read out the question for you. So the first question would be, do you believe, this one is very interesting, there is already an AI bubble? And how you view the current wave of technology and AI investments? How long might this trend last?
This is actually a very, I guess, timely topic. Mm-hmm. We start to see on the news headline a lot of words, or if you do word search, AI bubble, now it's being talked about everywhere. It is actually, in fact, one of the topics, in fact, our investment committee even discussed this month. Is the bubble, are we in a bubble? I would say potentially the bubble could be forming. However, we find that still it's an early stage. And the reason we say that is that if we look into 2026, companies' spending plan CapEx plan is already quite fixed and very healthy. It's already fixed. So we find that still the demand definitely likely to come. And when we look at the technology sector, still a lot of the spending is done within the free cash flow they generate. So we haven't seen the free cash flow from the technology sector turning negative. If we start to see that turning negative, then we might be actually going a bit too far. But we find that still within sort of the free cash is getting tighter, but still positive. And that is still an environment we find is sustainable. And probably for next year, I think it's fine. But we probably, as we think about maybe beyond 26, maybe 27 and so forth, we need to keep monitoring where the progress goes. But we find bubble could be forming, but we're not worried about that to the size to be burst.
Thank you. So AI is still developing in a very good way. Don't worry. So now moving on to our second question. Does Schroders have any recommended allocation ratios? For example, like 60% of equities, 40% of bonds, or a mix of equities, bonds, and precious metals?
The typical one that we often hear in this industry is 60-40 or 50-50. Those are definitely more general, typical allocation we do here. But ultimately, my belief is that there's no one answer that fits everyone. Depending on where your financial needs are, depending on where your income needs are, how far you are, and when you need the cash, the allocation could be different. If you don't necessarily need the cash but want to maximize the return, you should put higher in the equities and don't worry about the volatility rise or volatility through. But if you have certain cash needs in mind, you don't want to be putting a lot in the higher risk assets, you probably want to have an asset that gives you sort of the cash flow that you don't have to necessarily think about liquidating assets. So the right answer is different. Typically, I would say for more like a pre-retirement sort of the audience, obviously the younger generation should be putting much higher in equities. I've also heard someone say, oh, I just have cash and crypto. That's a very young generation. Unfortunately, not my generation. Marita might say something different. But I heard that, but that's not what I would do as a multi-asset investor. But younger generation should be definitely putting more in the higher risk category. Probably those that are probably reasonable wealth level but still working, probably can still afford to have 60-40 like, but then sort of approaching the retirement and post-retirement. But by the way, post-retirement, in my opinion, doesn't mean suddenly you go to bonds, because Asian people live long. Everyone here is gonna live many, many years ahead. Nice. So make sure that you need to have some income, but also have some return. So generally, there's a risk appetite should change over time, but the right answer is probably different for everyone, so I don't want to stereotype. And you should talk to professionals.
Right. So the allocation will be very different, depends on the scenario.
Yes.
Right. So the third question, do you expect the US labor market turning tight status to a poor one? And when might that happen?
I guess the US labor market having gone through a bit of the structural change, because there's definitely there's an element of, I guess, the immigration is tighter control. So some of the service sector, the labor market is very tight. It's hard to find workers. Potentially either paying for the higher wage, or this is also why a lot of the technology investment is going on to increase the efficiency of the existing workers. So the market could be tight, potentially for the reasons that the government wants. I would say that probably if we start to see tight, but because the economy is strong and there's enough demand, if we see potentially the technology to supplement to keep the inflation down is fine. But if that somehow it cannot be controlled, then the inflation gets higher. It's not the labor market itself, but the tight labor market causing the inflation beyond control, which then start to make the Fed not being able to cut anymore. That could be a potentially a risk. But right now, I think the data doesn't really show that.
Right. So right now, the technology is able to support the tight labor. Right. So moving on to our fourth question, this year has been an outstanding year for emerging markets. Do you expect them to continue outperforming developed markets next year? And what is your overall outlook for Asian markets?
So I think I did mention that the Asia market, especially technology sector, is much more reasonable valuations than some of the developed market. And certainly the demand for, we believe that AI is a real thing, and we believe the investment will come. China potentially also invest more to be independent from the US technologies. We know that the technology is not exclusive to US market. We know that. So from that perspective, we find that the emerging market, Asian market, that started to play actually quite nice catch up this year. It's only 1 year. Before that, we had the US market outperforming the rest for many years. So we think there's a room to go. So therefore, we still do like the emerging market, including Asia and probably broad-based Asia, rather than single country. I think the region in aggregate has a lot to benefit in this cycle.
So still very positive looking in the emerging markets. Right, so moving on to our fifth question, precious metal. No, the other one, okay. For investing in emerging market debts, among hard currency and local currency dominating bonds, as well as sovereign and corporate debt, how should investors choose among these options?
First rule of thumb, don't put all your eggs in one place. So therefore, it's always better to diversify. However, I think if we are to look at the emerging market debt space, there's always a trade-off between dollar and local currency. We find at this point in time, because there are big questions around sort of the, I guess, confidence in US dollar, having a local currency rather than a hard currency does give you something different to move away from dollar. As I mentioned, I think everyone needs to think about moving a little bit away from US dollar. So from that perspective, definitely the local currency does look interesting to us. And another thing is, if something were to go wrong in the global economy, US being in a rate cutting cycle gives all other countries a bit of the fresh breath of air in terms of other central banks also to be able to cut. Because previously, because to think about the currency impact, if the US rate was very high, it was very hard for other central banks to cut rates. Now the US is cutting. Other countries also, when they need to, can cut easily without worrying about the currency. So I think from that perspective, currently, at this point in time, I do find local currency debt as interesting.
Interesting, but diversify is still the key. Okay, so moving on, the sixth question. With the US and other major countries continuing to expand fiscal policies, what is your outlook for US and global government bonds? And what yield range do you expect for US treasuries by year end and next year? Are bonds still worth investing in?
This sounds like an institutional investor asking me, where is your fair value range question? I find that I do share that medium-term outlook, fiscal policies. Not every country, but certainly US talking about one big beautiful bill, Europe talking about increasing defense spending and removing some of the debt limit, my home country, Japan, talking about spending. There are many, and potentially I'm sure China also stimulating economy. There are many countries talking about sort of the fiscal side of the policies because the growth is potentially slowing. I find that generally policymakers around the world have become a lot more interested in avoiding recession at any cost. If we think about some of you who actually have been around this finance market long time, we always had recession. We always have healthy cycles. I feel like the cycle's getting stretched, and the government around the world almost criticism for having recession. So the recessions become something that the government really, really tries to avoid. And as a result of that, there's more fiscal spending. And as I show on the EM local currency bond chart, some of the developing economies are having more debt burden. I believe longer term, there will be some consideration of the fiscal quality, and potentially will mean that the curve, treasury curve generally will stay steeper than we've seen in the past decade. And we already have seen the curve steepen meaningfully, but we think the curve will stay steeper. But at the same time, if we are in a cutting cycle, the market is an interesting thing. Do you look at what's happening today and next few months? Or do you think about 5 years thing? We should think both, but we cannot do both, so usually the market looks at the front end things more. So from that perspective, because we are in a cutting cycle, the market focus on the fiscal side is probably a bit delayed. If we are to see higher inflation and Fed not being able to cut more, I think also it's not going to be only about the inflation, but the concern about the fiscal quality will quickly come back into market focus. But today, when we look at the inflation numbers, despite all the things we had on tariff, actually the broad inflation is stable. So probably at this point, something we can only think in the back of the head, not the main theme.
Thank you. So to move on, so next question will focus on precious metal, like gold and silver. And as precious metals have surged in the second half of this year, what is your view on their performance next year, including like target prices and potential upside? What proportion of gold would you recommend in a diversified portfolio?
So as I mentioned, we certainly see more investors, institutional investors, wanting to include gold in a strategic allocation. But gold is a difficult one, because if I run the beta analysis of gold today versus equities, I think the beta is like almost 1.5 to 2. If I run long history, gold beta to equities 0.4. 0.5. It's a very defensive asset with a reasonably high volatility. So this is where it gets tricky. I would not say that put everything in gold. That's not the idea. Typically from the diversification view, also having 1 or 2% probably doesn't do a lot, especially if you have a lot of equities on the other side. So again, it becomes what is the rest of the asset? But typically, probably to have some meaningful impact in the conservative portfolio, probably somewhere between, say, 3 to 5% would do. If it's more in the equity-heavy portfolio, replacing some equities with 5, probably, well, depending on how positive you are. When you're very, very positive, you can probably have a bit more than 5. We're probably anywhere between 5 to 10 within the equity space makes sense. But that's something, again, gold is a very a bit of the having a unique phase now, but also the correlation is different, so you need to pay attention to that volatility carefully.
Thank you for the recommendation. So moving on, this is our 8th question. Can European corporate earning growth compete with that of the US or Asia?
Difficult. But again, that's aggregate. It doesn't really matter in terms of then when you look for certain companies, certain sectors, it's a very different story. When you just put the regional things together, I guess because Europe simply from also the potential economic growth being lower, and then reliance on, I guess, the export being a bit less compared to, for example, some of the Asian economies. So it naturally inherits the natural growth rate of the European economy, which is lower. Doesn't mean that all the companies are the same. There are certain sectors that does great, but also different points. That's why I've said that when I look for opportunities, you look for definitely naturally more growth stocks or stories in US and Asia, but in Europe is maybe not necessarily the greatest growth, but if you are looking for dividends, European companies pay very healthy dividends because they are a bit more mature sectors as a proportions higher. As a result of that, they do pay much heavier, much nicer dividends. So if you are looking for something a little bit more defensive, but maybe income like equity investment, Europe is actually better and gives you more stable return. So different ways of looking at which market. It's obviously, if you're simply looking at the profit growth, Europe is lagging. At the beginning of the year, we did see Europe actually doing well, but it didn't last very long. So I guess from the structural viewpoint, tougher, but doesn't mean that there are different ways to find opportunities in Europe.
Okay, so different ways depends on how you view the profit. Okay, so moving on, the 9th question. If the market experiences renewed volatility, will the US dollar once again be regarded as a safe haven currency?
If we are to get US recession, definitely dollar will be the safe haven. I think in the current environment, because we don't believe there's a recession right away, probably we don't need a safe haven. Currently, I would say if because of that, I would say because the US is in a cutting cycle, recent probably safe haven currency is not dollar, it's not yen, it's actually probably right now Swiss franc. But if we are to see global recession, including US, the largest economy today still, then dollar would come back as a safe haven currency.
Right, thank you for the points. And now to move on to our 10th question. Can you please share your view about Japan equity market and JPY?
I didn't necessarily have the best record when it comes to forecasting Japan in the top 10 predictions, so you notice I excluded those. I guess Japan is a tricky one. Recently, because of the new leadership, I do find that we are sort of a bit wait and see mode in terms of what government can deliver. But more importantly, it's not about the first female prime minister, which I'm personally very glad that we have one, and we are ahead of the US for once, so that's pretty good. But jokes aside, I think the issue is that the LDP in Japan is quite weak. So in order for any policies to be made in Japan, it requires coalition and soft coalition partners to really agree on the policies. And therefore, easiest one typically, especially with the upcoming election in mind, for the parties to agree on will be the one to stimulate the economy. Again, sort of the spending. That potentially put a little bit more pressure on, I guess, yen because of that. And at the same time, the government is quite clear until they see more further wage increases to support the consumption, putting the pressure also on BOJ. BOJ is independent, but they also have known to work very closely with the government in the past. Certainly in the Abe administration days, BOJ and the government were very close. And the current prime minister come from that group. So they believe in not controlling the policy, but coordinating the policies. And from that perspective, probably the BOJ will be slower in raising interest rate. So that potentially will put a little bit weaker bias on yen near term until the wage increase is confirmed probably next year. Until then, if the yen is weaker, most likely it will be helpful for export stocks, as we've seen the Nikkei doing great because of the higher export presence. But if we are to see the domestic stimulus come through and market recognizing the power of that, then we should start to see topics should do better. But right now it's the yen play. So yen's weaker side, probably for next few months, then likely to be a bit more helpful for export stocks rather than domestic stocks.
Interesting. So, well, Keiko, thank you so much for so many valuable insights. I'm sure we all learned a lot. Right. Once again, big round of applause to Keiko. Thank you so much.
Thank you so much.
Thank you, thank you. 谢谢 Keiko 非常精彩的分享。我相信很多的洞见呢，对于所有的投资朋友来说呢，都是非常非常重要的，作为我们投资的指南针。
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。